We have always taken help of the best fund managers of the mutual fund industry, and the stalwarts of the industry have spoken to us and our clients over the last 8 years. However, I have always felt that it was important to share our thoughts also, and this is a presentation I was very honored to do in a club in Calcutta, and the response was extremely good. So we came to know from many of them that they would like to note the points of the presentation, and so this webinar is all about that. So let's. So we have a chat box. You can write your messages. Obik has put all of us on all the participants on mute for the time being, but this presentation will take around 25 minutes, and then after that we can open it up for question answer. So so just a few lines about Wealthapp. We started in 2014. Currently we are a 22-member strong team with 8 very senior banking professionals who I had the honor and pleasure of working with in my banking days, and I'm so glad that they are now a part of Wealthapp. And the kind of bench strength we have in terms of experience, I doubt whether some of even the best of banks would have similar seniority and the similar kind of in-depth, knowledgeable people in the team. So Wealthapp is all about clients, and our endeavor has always been to give them the best possible suggestions. We are financial planners, so our job is to primarily sit down with our clients, note down their needs, and accordingly try to suggest the best products which they can gain from. Can we go to the next slide, please? Yeah. So we are not stock advisors, insurance agents, tax specialists, or bankers. We have given our entire professional life to manage clients' wealth and be there with our clients for generations. So over the last, decade or so, as you can see, Indians have been saving almost 28% of their income, and that makes us among the best countries in the world. As you can see, the gross domestic savings as a percentage of GDP in the world is now about 27%. And Indians are saving 28.2%, which as compared to other global peers, we are doing a very good job. Well, China, as you can see, they are saving 45%, and this has led to China's enormous growth over the last 2 decades. This gross domestic savings of 28.2%, if it is channelized to the right areas, India can definitely gain from it, and it's not a 1-year phenomenon for India. India has been a high saving country for years, and over the last 10 years, our average gross domestic savings to a percentage of GDP has remained in and around 30%. So where are this 28.2% money going into? As you can see on the pie chart on the left, properties are still almost 50% of our gross savings. The rest of the savings stack up as 16% or gold, 15-16% bank deposits, insurance funds, provident funds, cash, and about 4.8% into equities. Now, here is a decadal chart which primarily shows us how India has progressed over the last 40 years. And as you can see, these bars represent inflation and GDP of India every 10 years. So So as you can see, the bar on the left is the decadal performance of 1980 to 89. Here, the light bar, as you can see, represents inflation, which is 9%. And the dark blue bar is 6%, which was a GDP growth of that decade. So as you can see, inflation of India has remained somewhere around 9 and 10% in the last in 80s and 90s, and the same inflation actually dropped to about 6% over the last 20 years. Now, what is a fixed income investment doing is primarily trying to cover inflation for you. So as you can see, we have given a second bracket to mention debt returns or any fixed deposit, investment returns in India will follow that curve. So if Indian inflation remains at 6%, any fixed income instrument will give you about 6 to 7% return. And if Indian inflation drops to say 3%, fixed income instruments will give you 3.5%. That's the nature of a fixed investment or a debt investment. Similarly, what we get from the equity investment is basically the addition of the two blue bars. So if you are expecting that top number of every bar, which is 15, 16, 13, and 13, will be the total return that one can get from equity investing. Now, this the four bars also tell us that every decade India has gone through massive events, and some of the key events have been noted, and we generally can relate to some of the darkest events of the world that India has faced, but yet Indian markets have held strong. And just to summarize this particular chart, your total return from a fixed income instrument will be equal to the inflation of the country, and the equity returns or the best of companies will give you a return which is equal to the nominal growth of the country. So nominal growth minus inflation is the net GDP number, and this decade of 2021 to 30, India has started very well, and World Bank and other institutions across the world, they are predicting that India will be able to grow at 8%. So if India grows at 8% GDP and inflation is 5%, so the best of companies or Sensex return, as we can say, will be equal to 13 or 14%. And this has never really changed. So as a fixed income investor, you will replicate the performance of inflation. You will just try to keep your nose above the way the cost index is working in India. And if you be a part of the equity investments, you will get a total nominal return. So how over these 40 years, investments, different kinds of investments have done. So can we go to the next chart, please? Yeah. So here you can see that since 1981, we have taken 5 different parameters. We have taken the indexation table. As you all know, in India, government publishes an indexation table. So if we take indexation table since 1981, indexation table has grown by 6.72%. So in other words, anything that was costing X a year back has gone up by 6.72% in India. So as we all know, to make real returns from our investment has to do little better than that. Otherwise, we have invested in a product which is giving us negative compounding. So if costs in the country is going up by 7%, minimum return that an investment product should give us is 7.5% or 8% for us to make that 0.5 or 1% more than the increase of all products in the country. So in this parlance, SBI 5-year fixed deposit has grown by 8.79%. Now, obviously, there are tax impacts on this, but leave that aside. A standard fixed deposit investor for the last 40 years has actually got 2% more than the indexation growth in India, which as compared to other investments like gold has actually done phenomenally well in the last 40 years. So as you can see, 10% plus return from gold, and that too in the last 10 years, gold has actually done even better, almost 11% kind of returns one has received from gold. Now here you have to understand that the kind of investments that Indians have been doing in gold is primarily into ornaments, and ornaments obviously has making charges and all that. So the real received return might have been a little less, but today in India to invest in gold, you have gold ETFs, you have direct investment into gold bonds, and Indian government sovereign gold bond gives you the return of gold plus 2% extra. So gold can be an important part of your overall asset allocation, basis the historic returns of gold, which has really done exceedingly well in India. Now, we are taking an example of a flat in a metro, and this number is obviously not a very verified number, but we have taken flats in Bombay, Delhi, Kolkata, and the Kolkata flat we will discuss in next slides. But more or less, if you see over the last 30-40 years, I personally live in a building which is in a prime area in South Calcutta, and the building came up in 1977. So I have taken into account what anyone who have bought a flat in that building in 1977, what is the value of the flat today. In property investing, one thing is also very important, that when you have a property, you can add a rental income also to that. So this is taking the whole return into account for a flat in metro. Now, some of you must have received better returns than this. Some of you may not have received this return, but more or less, there's an average 10.5% and has been the return over the last 40 years from property. But this number, as I said, is not verifiable. This is an indication. And on the right and most, we see the Sensex return. So Indian Sensex first started at 100 in 1979. So we have taken averages of 81, and if I calculate that 100 becoming like 55,000 now, more or less the return has been 16%. Now, the question is, most of us as wealth managers and all have been telling all our clients that, you should have been more into index because that would have given you 16% return, and other investments have given you much less. As you can see, one value of rupees 1 lakh in a SBI FD would have made it 31 lakhs, whereas Sensex would have made it 4.34 crores. However, let's understand 2-3 points quickly. One, there was no Sensex or index investment available to Indians in 1979 or 89 or 99. So you had to pick up the companies of the index in the proportion of the index to replicate a return like this. Now there is a standard convention that many of our clients tell us, okay, I will pick up the best 10 companies and sit tight. Now, had anyone done that, what would have happened? So primarily to tell you that every decade we have seen about, out of the 30 index companies, about 10 of them cannot remain in the top 30. So Sensex has actually gone through a big churn over the last 30-40 years. So as much as lucrative this number on the right looks like 16%, not too many people have really received 16% return, and the real return received by Indians have been much lower. So in the next slide, we have tried to demonstrate how companies have moved in the Sensex over the last 40 years. The bottom line is only 6 companies, as you can see there, HLL, ITC, L&T, Nestle, SBI, and Tata Steel. The 6 companies have actually stayed firm in the index for the last 40 years. So this is a little bit of a jumbled slide, but on the left, if you see, we have listed down the 30 Sensex companies in 2001, and we have highlighted the companies in yellow basis, which are the companies are still there in the index. So as you can see, the top, if I start reading the companies, ITC Limited, is it there in 2022? Yes. ACC? No. Bajaj Holdings investment has gone through various reformations, but as a Bajaj Holding is not there. Zee Entertainment is not there. Bharat Heavy Electricals, not there. Reliance Infrastructure, not there. Castrol, not there. Tata Steel is there. So like that, we have taken into account the companies which are still there are 6, and some of the companies which were there in 2001 wasn't there in 1979. So in this buy and hold philosophy that I will buy the best businesses and hold on, had you invested in these 6 companies only 15 years back, what would have been your return, which is shown in the table on the right. So the returns from HLL has been phenomenal over the last 15 years, as you can see, 18%. ITC, on the other hand, has given 12.96%. Last 5-year return of ITC, as you know, has been quite dismal, which is just about 1%. But last 10-year return, ITC has been about 8%. L&T has been has given only 10% return over the last 15 years. Nestle has been the best performing company, as you can see, 20% return over the last 15 years. SBI is 9.73%, and Tata Steel just about 1.95%. So the average of these 6 stocks would have given you 12.41%. So buy and hold strategy, buying the best 6 businesses of India equally, you would have received a return of 12.41%, or your value of rupees 10 lakhs would have become 57 lakhs in the last 15 years. Now, as against that, what different investment would have given you is given one by one. As you can see, you would have actually got fantastic return had you invested in a small cap fund. So what we have done is we have taken the average return of all large cap funds, average return of all small cap mutual funds, and you can see large cap mutual funds 14.75%, or your 10 lakhs would have become 78 lakhs, and small cap mutual funds would have given you 17%, or your 10 lakhs would have literally grown 10 times over the last 15 years. As against that, Sensex has given 9.31% return. SBI fixed deposits have given 8.5% return. A normal government security fund would have given you 8.21%. Gold, as I said, has done phenomenal in the last 10-15 years, or 11.6%. And our value of a property would have grown by 9.25%. Here, to be specific, we have taken an apartment of South City complex of Calcutta. As you know, the complex started in 2006, and so there are many friends of ours who have bought properties in South City in 2006 and are still holding on. So if you grow the number, it will grow at about 9.25%. Now, bottom line of all these numbers is that it is not easy to get that Sensex return of that 16, 17, 15% that we talk about if you are supported by the best fund managers with their minute understanding of the market, companies. They will be able to give you the returns of that 14, 17%. Otherwise, just by investing in the index, or just by investing in a few businesses, or just by doing something or the other, it will be very difficult to compound your money at 15–16% every year. Obviously, this will not be a straight line. 15 years will show you at least 5 to 6 years of negative return, and it becomes even more unnerving for an individual investor to hold on to good businesses during that unnerving period. Just imagine you are just holding on to Tata Steel for the last 15 years, knowing that it's from the Tata Group, it's the best steel company, but still India is the second largest producer of steel in the world today, and you have just got 2% return. Now, that really is the crux of everything. That why, as a financial planner, we sometimes equate our role as a mutual fund distributor, is because mutual funds have really done exceedingly well when it comes to long-term performance. So just going to the next slide. Over the years, what you did was right. If you would have invested in SBI FDs, if you had invested in gold, you have not really done anything wrong. And that is why the next slide literally shows that smart Indians, when it came to communication, we have actually used the media that was available to us. So we wrote letters, we used land phones, we used pagers, Nokia phones, BlackBerry, and now I'm sure each one of you is using a smartphone. However, and why do we do that? Some of us still fancy a land phone in the house, but for 90% of our communication, we use a smartphone because it brings the right value on the table. And in that regard, as you can see, I think it is the right time for us to go. Next slide, please. Yeah, in that format, we had invested in gold, post office, SBI, bank fixed deposits, company fixed deposit. But I think the value that mutual funds really bring on the table right now, we can certainly say mutual funds sahi hai. So again, this is a tremendous jumbled up kind of a slide, primarily trying to show you over the last 10 years globally which asset classes have ranked where. So even when I said gold has done exceedingly well, if you see that YOLO gold cell has moved literally all across like a snake and ladder game. It was for 4 years, it was literally at the bottom, and then it came to the middle, and then over the last 6 years, 3 years, gold was either in the top 3 asset classes. Similarly, even Nifty, which is giving you 10%, 15% return, if you see the green bar, Nifty has just remained number 1 only in 2018, and most of the time it has been in the middle, going like a zigzag. What this is also saying is, as an investor, every year you will find one asset class which will do so well that you will be compelled to invest in this asset class. And what has really been most compelling asset class to invest in the last 2–3 years? You can ask our next generation. That asset class is Bitcoin or crypto. So if you see the top line, crypto or Bitcoin has remained as the top asset class for almost 8 or 9 out of those 10–11 years. Now, I'm sure all of us heard of crypto for the first time last year. And most of us got very, very interested to invest in Bitcoins or crypto over the last 2 years. And only this year, as you can see, Bitcoin isn't doing too well. In fact, in the last 6 months, some of the crypto returns have been less than 50%, 70%. Some have actually completely wiped out the investment amount. So all that this slide is trying to say is self-investing will generally be a very, very difficult path. And most importantly, we will get dragged into past performance, which in investment terms, we call it recency bias. any fund or any scheme, any asset class which does very well in the last year is the hottest asset class that we invest. So the investment experience in shares also, I'm sure all of you have dabbled into the stock market in the past, but most of the time you have actually got into the market just before the subprime crisis, just before the tech bubble burst in 2000. We actually get dragged into equity investing when markets are very high. And when markets are low, nobody talks about it. And that is actually the right disciplined way of investing. Either stay invested or build it systematically or buy when others are not buying into that asset class. Let's go to the next slide. Yeah. So, going by the name of this webinar, so what are FDs and what are the alternatives to bank fixed deposits? So on the left, we have given some taxable options. On the right, we have given some tax efficient options. There are 500 options available. We have picked and chosen the ones we think are good for our clients. So just like traditional FDs is a very good alternative for short-term investments, post office savings, NBFC and fixed deposits like LIC Housing Finance or HDFC Housing Finance. For senior citizens, senior citizen savings scheme or Pradhan Mantri Vayu Vikas Yojana are good investment options. We have the current variant of RBI bond, which gives you a 7-year bond. It's a floating rate bond, gives you fixed for 7.15% in the first year, and then it becomes floating. However, over the last 4-5 years, this RBI bond has kept 7.15% as a return, and they have not tinkered around with that. And pension funds from life insurance companies, especially funds from LIC called Jeevan Akshay. These are very good taxable investment options. Similarly, if you're in the 25 or 30% tax bracket, there are some investment options like Bharat Bond, Nivesh Laksha Fund, simple government security, investing in mutual funds and bonds are your options. Now, I'll spend one more slide on the option like Bharat Bond. These are primarily dated mutual funds. So mutual funds, as you know, are generally open-ended mutual funds where you keep on getting your returns. But there are certain bond funds like Bharat Bond. Abhi, we can go to the slide. So I'll just spend 1 minute on this slide. So in general, we have in our mind, we say, okay, interest rates may go up or go down. But if you think that interest rates will stay where it is, I don't think it is going to happen. So if interest rates go up in India, then you can remain liquid. But if you really think India interest rates have been on the sort of a consistent decline over the last 2 decades, and India may keep its interest rate low over the next 2 decades, then you have to look at your the duration of your debt investment. So primarily what I'm saying is, if you come to know that you are given an option by State Bank FD to invest in 1-year FD or a 10-year FD, and if you think interest rates can keep going down, you will try to obviously buy a 10-year FD. If you think interest rates will go up, then you will buy either the 1-year FD or a simple keep your money in savings account, let the interest rate go up, and then you can invest in a higher interest rate. So in that format, if you think interest rates may go down over the next 10 years, Bharat Bond can work as an excellent alternative, and these are many options are available in the mutual fund space. These are target maturity debt funds. So literally you invest, okay, it's a 10-year product, and after 10 years, if you stay invested, you get a return which you can see from now. Okay, can we go to the next slide, please? Yeah. So as you can see, these are the target maturity returns. So right from 2023, which is a 1-year maturing bond, which will give you 6.3%, to 10 years, which is 7.69%, you have different target maturity products available in the mutual funds space. In fact, I was just mentioning about Nivesh Lakshya fund of Nippon, for example. It can keep it, even give you a target maturity till 25 years. So from now till 2045, you can invest in Nivesh Lakshya and you can get a return which is say 7%. And for 25 years, you have locked that return. But you have not locked your investment. So you have invested in the bond in Nivesh Lakshya with an expected with 7% return, but in between, if you need liquidity, you can always walk out. At what rate you will walk out will the interest rate of the market will determine. So if you have invested in 2022 and after 3 years you need money, and from 22 to 25 interest rates in India may say has gone down by 1%, you will actually walk out with a premium. So you will get more than 7%. But if interest rates go up in the next 3 years, you may get 5%. But if you stay invested for the length of the investment, your returns are given here. So if you have money for 10 years, 7.69 can be your return over the next 10 years. And your taxation on this will be like capital gain. So your net of indexation, the long-term capital gain tax that you pay will be somewhere around 60 to 70 basis points. So you can literally look at a 7% post-tax return for 10 years with liquidity from a Bharat bond, which has literally no credit risk. It is one of the safest investments available. And it is not the only product in the market. There are various target maturity returns which are available in the entire mutual fund space. So something that may be a decent alternative to investors who pay tax on their fixed income. Okay, so here this is literally the last slide of the presentation. So there are two game changers that make a big difference to your net returns if you're a fixed income investor. The first is tax treatment. So if you pay 30% tax, obviously if you get 7% return, and if you pay 30% tax, your return will drop to 4.9%. Similarly, if you pay long-term capital gain tax, your returns from 7 will drop to 6.5. So you can make a clearly 1 or 2% more just by looking at what is your tax impact on your return. The second game changer is very interesting. We have all been fed with this thought process that invest in a cumulative FD if you don't need the money. Now, this is actually a very bad option. The idea is you are investing in a very safe product like fixed deposit. If you need the interest rate every year, every quarter, please take it. But if you don't need the interest rate, don't reinvest it back in the FD. Try to invest in equities, or just simply put, the bank that you have chosen to do the FD, put the interest earned out of the FD into the share of that same bank. Because over a long period, no good bank will give you more in fixed deposit and take less for their shareholders. And I will show you in the next slide what happened. But just to remain in this slide, if you are investing in a 7% product, target maturity product of mutual fund, and you want to take that 7% off your table every year. So you have invested, say 1 lakh rupees, and you are getting 7% return from that product. So every year, 7,000 rupees you are taking out from the product, and you're using it for your own self. Now, this 7,000 rupees is taxed not on the entire 7,000 rupees. So if it is bank FD, your tax will be on 7,000, 30,000 tax, 30%. But if it is a withdrawal from a mutual fund will actually sell a few units and give you that 7,000. Now, this taxation on selling of those units is treated as capital gain, and that reduces your net taxes drastically. From 30%, your tax actually, if you see the third bar the column, the percentage tax paid is actually around 3%. On the withdrawal, it starts from 1.96%, then 3.8, then 5.51, but again drops because after 3 years you get indexation benefit. So this is a complicated chart to suddenly see and understand. But just to leave you with that thought, that if you are an investor in fixed deposits and you are paying 30%, your net returns will drop. You have to look at products which give you a better tax efficiency. And if you need the cash flows, take it. If you don't need the cash flows, please reinvest the cash flows into equity or the share of the same bank you have chosen to invest. If you have done that, if you see the rightmost column, your returns would have jumped from 7% to 8% in just 1 year, in just 10 years. So primarily from a FD investor, 7% becomes 5%. And for a smart investor in target maturity coupled with little bit of equity, it can go all the way up to 8%. So it's a 3% clear difference that smart investing can do today. And that is why I was telling you that mutual fund Sahi Hai can be the right alternative of a smartphone for 2022 investors. Going to the next slide. Here is a very simple thing. If you had invested over the last 15 years, money in SBI FD, you would have got 6.5%, or your 10-year post-tax would have become 25 lakhs. Similarly, SBI share would have given you 40 lakhs at 9.73. ICICI Bank share would have given you 10. Axis Bank 13, HDFC and Kotak Bank has done phenomenally over the last 15 years, or 18%. So literally what I'm trying to say is, as an investor, if you have short-term money, 1 year, 2 year, 5 year, you can do whatever you want, won't make much of a difference. But if you have money which is more than 5 years, 10 years, then equity may be a great friend of yours, especially if you don't need the cash flows. At least put those cash flows into equity returns. So every 1%, and this is like a lot of our clients, we have found that they say that, we have been investing 1% idhar udhar kya hoga. But I think 1% will make a big difference to India. So if you really are invested in bank FDs, and if you get 1 or 2% extra return, I think that will help, generate literally some extra return that you can think of giving away in charity or philanthropy. And that is how India will be greatly benefited. Also, I would here like to leave you with one thought that, when you are writing your will, please try to see if you want, there is a way to give some part of your assets in charity. So there are processes by which we can actually transfer some part of your money to philanthropic purposes. Sometimes we also mention that for kids living abroad or NRIs, even parents just write saying that in my absence the money will go to that foreign country. If you want that money to give something to India before it moves to a foreign country, that can also be worked upon. So in Wealthapp, what do? We just follow the process. Some of you are our existing clients, so we try to first understand the risk profile of our clients. Ultimately, investing money should be all about happiness and obviously market volatility will be there, but it should not disturb your night's sleep. So that is what we generally try and do. First, understand the risk that our clients can take. Then we put down their existing investments into one page, which is very important to see where all the investments are lying as on date. and then we try to see what will be the return if we change that current asset allocation into a more suited asset allocation for our clients. Yeah. So this is how we list down our clients' investments. So we try to figure out what is the percentage of debt, equity, and alternates in their portfolio today. And in the next slide, we will let's go to the next slide. So we sort of put these cash in, cash out, age-wise, year-wise, so that we also understand the elasticity of the portfolio. So what I mean by elasticity is nothing but when I am doing a projection for a client for say 20 years, and we are seeing that, okay, he has 100 rupees, which will become 500, 700 rupees over the next 10 years. What kind of money he can spend on his travels every year? So what is the kind of elasticity the portfolio has? If the client wants, can he go to a foreign trip every alternate year? And can we set aside, say, 5 lakhs from the portfolio for that foreign trip? And then what will be the long-term impact on the portfolio? So that is what we measure for every client. And lastly, what we present is a cash flow sheet. So now we will, this is how a cash flow sheet is represented. This is also important to see if, say, as you know, asset classes will give different returns. So sometimes if an asset class gives you more returns, then the percentage of that asset in your portfolio will change. So we have to sort of keep cutting in an asset class when it is doing well, and similarly adding to an asset class when it is not doing too well in a very disciplined manner, so that we take advantages when markets, say, for example, come down by 15%. Sometimes we call our clients and say that let us transfer some part from debt to equity. And this is what we do it in a very disciplined manner. Most difficult thing to do, let me tell you that, but we still try to call our clients, and they, over the period when they work with us, they also understand that we would like to see their money grow, and that is in the interest of everyone. And sometimes we have to take difficult calls in terms of asset rebalancing. So just to summarize now, we spoke about asset allocation. So asset allocation will actually determine 90% of portfolio performance. 9% will come from product selection, and not even 1% will be coming from timing the market. So if a client has an asset allocation of only 10% in equity and 90% in property or fixed income, even if I or anybody gives the best advice on the 10%, overall return will never become more than 10%. Similarly, if a client judiciously has a larger allocation to equity, even if those equities are large cap good companies and you get 12-15% return, your overall return will definitely be more than 10% over a period. So sometimes we even do leveraged options. So literally, say, for example, you have bought a lot of LIC or insurance policies, and those are lying, and you also know you won't get more than 5-6% from those portfolio. So sometimes we can even get into taking a loan against those policies and investing for higher returns. So as it is not a standard thing across all clients, but as and where required, we create opportunities of making your money work harder. So lastly, the summary slide. So let us look at it, what we discussed today. So we choose the right investments. India is growing, and it's soon going to be in the top 3 economies in the world. Just this morning, I received such a lovely slide from one of our clients, literally an elder brother, that I wanted to actually include that slide, but obviously I thought that we will share it with you at a later date. Indian interest rates may also align to global rates. So if interest rates go down, what you need to do? So reinvestment risk must be considered seriously. That if I have a FD for 3 years, after 3 years, if it if interest rates drop, then I might have to keep reinvesting my money at a lower rate. Similar alternatives can generate, say, 3 to 4% extra return post-tax. So as I said, you don't need to take risk all the time for extra return. Sometimes keeping your money absolutely risk-free just by taking smarter alternatives, 2 to 3% extra return can be generated. Plan your estate and philanthropy. This is a way to help our clients, help India at large. And process-driven portfolio planning leading to ideal asset allocation is the motto of Wealthapp. And we have been trying to do our best in that area. So thank you very much. I think I have overexceeded my time a bit. Now we can take some questions. There are some chat box notes that I can see. There are some 9 notes which has come.
Sir, you are on mute. We can't hear you.
Yeah, sorry. So, so he is asking us throw some light on the Indian interest rate scenario over the course of 1 year. As yesterday, Fed has also decided to take the interest rates about 12%. Okay. Am I audible? Obik?
Yes, Shomuda, you're audible, and everyone who has a question can unmute themselves and ask questions now.
Great. So, as we know, over the last 1 year, interest rates are going up, and US and other countries will see an increased interest rate scenario in the next 1 year. So if you ask me my views, I'm not an expert, but what I gather from experts is that we will go through this interest rate up cycle for at least 1 year more. And we have to be cognizant that when interest rates go up, we can remain more liquid with our money, so that once the interest rate top out, we can take duration investments. Sorry, is there any other question? Can we take?
Soumyajit, hi, Gargi.
Hi, cover.
Good, Valo. Soumyajit, I have one question. So I sometimes, like, just to understand the market, I do invest on shares, and I'm not investing even a penny right now looking at the negative numbers. So I want to know, does this situation where we see so much of negative numbers, and I've seen my mutual fund investments are also comparatively on a lower, but it's always, I mean, you told me that we should have patience and wait on that, and I totally trust on that. So my question is there a time which is not good to invest in mutual fund, like it is not a good time to invest on share markets? Some people said when it's bleeding, don't invest, wait.
Well, when it is bleeding, that's the best time to invest. Actually, you should avoid investing when people are asking you to invest. No, honestly, the consensus will never work in the market, because it's very simple. It's a market. So if there are 10 buyers and 1 seller, who will gain that day?
Okay.
So in general, we cannot time the market. And we generally advise disciplined investing. Disciplined investing is invest every month. That's the best thing one can do, SIP. Don't bother about the market. Similarly, when you get a lump sum money, then what to do?
Yeah.
You put that money into liquid and then do STP, as you have also done.
I have done, yeah.
Let's not put entire 10 lakhs in one day. Put it in a liquid fund and let's transfer 1 lakh every month into the market. The only thing that we as people who have seen 25 years can tell you that we have no idea what the market will do in the next 1 year, 2 years, 5 years. But this much we can tell you: over 10 years, 15 years, markets or equities will give you better than most asset classes. And the alternatives that we have is almost less than half. So an alternative to an investor like you is either you invest in equity mutual funds, you can get 15% return. The next best alternative is 10% or even low. So when you do an asset allocation in a young age, equities will have to form a part of your portfolio, and at a young age, it can be even more.
Well, Soumyajit, this is Uttam, and you manage my portfolio, but we often see that there are some funds which are giving continuous negative result, but you don't shift from that. Why so?
Very good question. Thank you very much. See, generally, when a fund underperforms, our experience is that next year that fund only recovers the most. There are some 800 mutual fund schemes that are there, and we try to choose those 3, 4, 5 maximum where we think it will do well. Now, that does not mean that from the next day those schemes start doing well, and that is why we don't even choose one scheme. So not a single investor of ours have one scheme investment. So we will take a mix of 3, 4 schemes so that they complement each other. So at any point in time, you take out your portfolio, even at the best of times, you won't find all of them doing 15%. There will be some which will do 5%, some which will do 22%. And when that scheme is doing 5%, that's the worst time to come out of that scheme. However, I must give you that sometimes some sectoral schemes may continue to do very badly. And like we had invested in, say, some funds in Greater China funds, we try to give some asset allocation to foreign investments, and foreign investments has not done well in the last 1 or 2 years. So sometimes we may have to accept that, yes, that may not have been the right decision, and we come out of it. But in general, if you are invested in diversified portfolios, and when the portfolios go down, we generally stay put.
In fact, from our end, what we find that when you came out from that China fund, we have already lost some money.
Yes.
And now again, there are few funds where we're losing money continuously.
Yes.
And what we find that, yes, sometimes we go up the ladder and again we came down, that snake ludo type game. And we wait for when we will recover the money. So this situation, I think, as an investor, we need to avoid with your guidance. So we'll wait for that.
Sure. Thank you.
Good morning, Soumyajit.
Good morning.
Ananda here.
Yeah, hi, good morning.
Now, I want to understand one thing. Suppose, is there any fixed formula for blend of both equity and debt? Suppose I am investing 30,000 in a month. What should be the percentage for equity and what should be the percentage of debt? Is there any fixed formula like that, or?
Well, it depends on person to person. But generally, when anyone is investing every month, it is always good to invest more money in equity, because equity markets are generally very volatile, and an investment every month averages that volatility in the favor of the investor. So for an SIP investor, say for example, 90% or maybe 100% of our SIP money is put into mutual funds, which are equity. We don't put money into debt mutual funds for SIP investments. We do it when somebody is, say, trying to create a travel corpus. every 2 years he or she wants to do a travel with 5 lakhs of rupees. So to create that corpus of travel corpus of 2 years, we may put that money into a fixed income or a balanced fund. But generally, SIP investments are done for longer duration in equity funds.
Okay, fine. In that case, Shubham, we need to transfer my debt funds to equity so that I can get a better return.
Any other question?
Yeah, good morning, Soumyajit.
Good morning, Gurudeva.
I was hearing, it was nice to see you and hearing, actually I am a client. I just wanted to tell that so many people have put so many questions here and these questions are not uncommon to us. It's very common questions and we are always worried with this. And every time we get worried when it comes down, when it goes up, we are very happy. So I am with you last, I think 7 years, last 7 years. So since 2015.
Yes.
So my experiences, I think I exhausted all these questions with you. And finally, what I'm finding is that, yes, mutual funds, I am not advertising for you, but I'm saying for my own, my experience is. Yes, certainly up and down is there in everywhere, but to what extent it goes up and down, that is more important. Suppose if I am in equity and all that, so it becomes more risky. So my blood pressure will be fluctuating more. And whenever I am in mutual fund, certainly it will be fluctuating, but it will not be fluctuating that much within the tolerance limit. So my 17% may become 10%. During COVID, it also went negative. So anyhow, that time everything was negative. So our life was under stake. So my experience is with you is that, yes, I think long term, certainly we gain it. That depends on everybody's objective also. But as far as I'm a retired person, so 2015 I retired, but from 2015 I started investing with you. But I can say that, yes, still I want to continue with you.
Thank you, sir.
That's what my experience said.
Thank you. Thank you for sharing. Thank you very
So
much.
thank you very much. Hope things will go like this.
Absolutely. With your blessing, everything will go right.
Thank you. Thank you.
Okay, can we take one last question? We have, I think it's already 10:30 plus. So can we take one last question? Okay. Thank you very much for your time on a Saturday morning. We will keep, giving you inputs on our understanding of interest rate cycle, because we are actually seeing abrupt interest rate upswing cycle over the last 1 year, almost after 40 years of regular interest rates coming down. We suddenly have found interest rates have started going up. So we will try to keep all our clients, especially the risk-averse investors, continuously updated on how interest rates are moving and how we can try to protect your returns during these turbulent times. Thank you very much. On behalf of all of us here in Wealthapp, we pledge to remain with you at all points in time. Thank you very much.